Could leave the floor to the next and last speaker of our session is Andrea Cupido. He has been heading the marine operation of Generali. Then we work as a colleague for just in excess of 2 years. Then a charming lady came and made him an offer that he couldn't resist, and today he's heading the marine operation of Swiss Re and the hull operation of Swiss Re Corporate Solution, Continental Europe. The floor is to Andrea Cupido. He speaks to us about how the hull machinery underwriters manage the cycle, and actually, how they matched with the downturn of the shipping industry after 2008.
27. Ladies and gentlemen, good afternoon. I will try to be as good as the other speakers to manage my time and not to be the sleeping pill of the group. As Federico said, I'm taking care of the hull underwriting for Swiss Re Corporate Solutions for Continental Europe, and I'm also a member of the Ocean Hull Committee of the IUMI. IUMI, for those who don't know, is the International Union of Marine Insurers. What we do at IUMI, we tend to meet once a year, possibly in an exotic location, and spend 3 days there, half of the time discussing of technical issues, half of the time moaning and complaining about the state of our market and what we can do to improve it. So my presentation will move pretty much along the same line of the IUMI conference. So I'll provide you with a little bit of macroeconomic background and the state of the shipping market, not because it's something new, but because it just helps me to fix the context in which we make our underwriting strategy and decisions. Then a little bit about the hull market, managing the cycle, and the usual moaning and complaining about the state of my market and what I can do to improve it. So I'll go through quickly the macroeconomic scenario with uneven economic growth and the emerging countries leading the economy and the recovery. The U.S. is starting to have an upturn in the economy, but we expect a slowdown of the downturn, but the economic recovery remains fragile. Emerging economies continue to remain crucial, and we expect them to definitely outpace the rest of the economies. The good news that once the crisis has worked through, the trade growth will outpace the GDP and possibly support the demand for marine insurers. Shipping market, nothing new for you. Apparently the ordering book is starting to move ahead in 2012. Demolitions, tankers and bulk carriers. Obviously bulk carriers are going to scrap at a higher pace of tankers, and in fact the bulk carriers fleet, from a point of view of the age, is definitely improving. Then we have the tankers, which are probably a little bit behind. Pressure on shipping persists. Freight rates are still low, even if I understand in these days there has been a little bit of recovery. Hopefully it won't be for the short term. Overcapacity. Overcapacity is a problem in shipping. The shipping industry is a problem in our market and in our industry, in the insurance industry as well. So, new capacity is still to come on stream, but at a slower rate than the recent years. So possibly next year we'll have a better situation as far as a balance between supply and demand. Elevated fuel market costs. We heard a lot this morning about eco ships and fuel-saving policies, different views. Interesting about low speed and what can be done about improving the fuel consumption. Shipping loans. This is the cycle of the banking industry. Apparently, a lot of the banks are claiming they're coming back, but I understand that most of the orders placed in the first half of 2012 have yet to be financed. Let's come now to the situation of the hull market. Marine premium by totally marine. When I say marine, I mean hull and cargo premiums. Hull and cargo account for 33.05 billions. Seems a lot, but it accounts only for 0.5% of the overall worldwide insurance premium. Most of the premium are still placed in Europe, but the emerging economies are always recovering, and we expect them to grow in the future years. By line of business, cargo is representing the largest part of marine premium. Hull is about 25%. Then we have energy and offshore and liability. By region, again, Europe is still playing a dominant role with the continental market, especially London, Nordics. Italy is playing an important role, France, Germany. But again, we have, the emerging economies trying to catch up. This is an important, interesting graph. It shows that there has been an increase on the worldwide tonnage, a decrease of the average insured value. Number of ships has increased, but not that much, whilst the global premium has increased, but not proportionally of the increase of the tonnage, which means that the average size of the vessels have increased. For the 5th year in a row, values have reduced. And despite this reduction of values, the portfolio of vessels with value in excess of 100 million has increased. What does this mean for insurers? That they have to take into account that is not only on experience, they have to rate the risk, but on exposure as well. Can it get worse? If you remember the MOL comfort, is from a pure hull point of view, was not a big loss because it was roughly 80 million US, but on a cargo side, we're talking about something between 300 and 400 million US. And we know about this new 18 TEU container under construction, which are really, providing a scary scenario as far as accumulation of risk for cargo and hull insurers. I've not spoken about macroeconomic and shipping condition of the market because I wanted to give you new information. This information are all well known by the shipping community, but because all this information have got an impact on our underwriting strategy. In particular, reduced earnings due to reduced freight rates means normally lower maintenance budget, ship underutilized go for repairs, increase in moral hazard. Lower freight rates means reduced asset values, which in turn may end up in increased constructive total loss. In this respect, I would add a further comment. You know that we insure vessel on agreed value. We are in a very strange situation nowadays that we have vessels immorally highly valued because of their mortgages, others which are either free of mortgage or with lower mortgage, which have a market value so low that can really, and are insured for such a low amount that can determine that a particular average claim can determine easily a constructive total loss. Apart from these challenges posed by the economic condition, the depressed economic conditions, we have other technical challenges. And I'm talking about increased cost of litigation, especially in the case of GA and salvage awards, environmental regulation, sanction compliance, which can end up in reputational risk, changing trading patterns. More and more vessels are adding to the Arctic shipping lanes, to the Northern Sea routes, crew competence, bridge management, vessel maintenance, port congestion, new technology. All these issues have to be considered by hull underwriters when assessing a risk. This is what we have been presented at the last IUMI convention. Technically speaking, for, they say, 17 years, hull is losing money. 2011 has been an unprecedented total loss impact with the Costa Concordia, but 2012 is moving similarly to the pre-Costa Concordia years. Less major losses, but still providing the scene for another loss year. This is because somewhere between 70 and 80%, hull underwriters start to lose money. Because on top of the claims we pay, we have the acquisition cost, we have the capital cost, we have management expenses. So I mean, it's something which is really proving difficult, and managing the cycle. To manage a cycle, it implies to have a cycle. When I looked for a definition of cycle, I found a definition which was saying that a cycle is the ability to measure a quote relative to a fixed, consistent benchmark, a zero axis. Then I said, I said to myself, we have no cycle anymore because our axis is not zero, it's at least minus 30, minus 40%. So if of a cycle we can talk about in marine, hull is definitely less elastic than it used to be. It's flatter and is definitely longer. I'm afraid this is the new normal we have to adapt. Apparently, for the last 20 years, our cycle is far different from the shipping cycle. Shipping, at least, has enjoyed a great boom. In my experience, I've seen that even when the shipping market is booming, we are incapable of changing our path. This is our cycle, consistently above 100% from mid-90s. So, does the hull cycle really exist? In my opinion, when an event like Costa Concordia that is not able to trigger any reaction as it did, I think we cannot talk about a cycle. So as I said, probably the new normality is a cycle where the rating level is pretty much the same every year. So is hull insurance an hopeless case? Hull is there are different opinions. Some may say that hull is a deliberate loss leader, a ticket to trade in another line of business. Somebody is writing our business to diversify. You know that according to Solvency II, writing not correlated business gives benefits in terms of use of the capital. There is too much and fragmented capacity relative to insured values. Pricing is unsophisticated. Risk selection is poor. There is a commoditization of the market. It's the broker's fault. Claims control is inefficient. Low barriers to entry. Actually, this is true. I mean, to write our business is not that difficult. I mean, there is always capital looking for return. You don't need an enormous capital to write our business. It's relatively short tail, which means that 3 years, 4 years, I mean, maximum, all the positions are closed. Or is more a challenging market. We cannot generalize. Probably somebody is making money. Somebody has found the good niche of business, the good spread, the good reinsurance arrangements. So, I mean, probably not everybody is losing money. The market is becoming more sophisticated in allocating capital and selecting and pricing risks. Verticalization of pricing is raising entry barriers. Probably there is a little bit of truth in both the position. So, solutions, remedies to this situation. Unfortunately, as I said at the IUMI conference, we have to play the drum of back to basics. Underwriting discipline and risk selection. Risk selection means learn to say no to our brokers, also to our clients, and improving our pricing methodologies and models. When we quote a risk normally as underwriter, I mean, when I talk about model, I don't mean we have to delegate the pricing of our risk to our models. Underwriting is not a commodity. All insurance is not a commodity. But the model, the pricing is a good benchmark against which we can compare our underwriting skill. And when we price a risk, we cannot price only on experience. Experience is the loss experience we have on a certain type of vessel, but to write on exposure and to factor the cost of capital, the internal cost, the external cost, which normally tend to be forgotten by underwriters. Training. The underwriting skill is definitely not as good as it used to be. So it's important not to underestimate investing in skill. Investing in skill means recruiting good people, young people, new generation of underwriters, and train. This is a cost, and not all the companies are prepared to invest. Our insurance is facing significant succession problems. It's a long-term investment to develop and retain his in-house talent. The number of underwriters is shrinking in every market. So whatever we decide to do is about underwriting discipline. Somebody said that insurance is a difficult business, but not a complicated one. That no matter what is the brand of your company, how big it is, it's all about underwriting discipline. This somebody was Warren Buffett in 2002 in the letter of the shareholders of Berkshire Hathaway. Since he's the infallible Oracle of Omaha, I have to think is the right way. Whatever we have to do it quickly, because otherwise it'll be another rock on our road. Thank you.
say 10 minutes. I mean, our 90 minutes you have been recommended.